Good afternoon, my name is Mario Becker. I'm the founder and CEO of Das Family Office, a Singapore-based multi-family office and independent investment advisor. In the following video, I'm presenting our annual review of 2021, as well as some thoughts on how we're looking at 2022. I'll be referencing our review document called Reflections, which will be linked below the video and which you can also find on our website. I hope you're finding the video as well as the document useful. "2021 was generally a very good year for the clients of Das Family Office. That was despite the fact that COVID is still with us. We were hoping last year that COVID would be defeated and that all the vaccination and booster programs would help to basically turn it into a flu. But for now, that's not the case. Let's hope this will happen quite soon. What we have is what I would say a kind of a stop and go economy. Certain parts of the economy are being opened, only to be closed at a later stage, or certain programs are being put on hold. As a result of that, we're seeing an environment of high inflation. Partly a result of supply chains that are not working as good, or rising energy prices. And there is now sort of a sentiment that this price increase or slightly elevated inflation will last a little bit longer. It will not be temporary as the Fed expected to be. So, and as a result of that, the Fed has now also fundamentally changed its monetary policy. Initially, sometime last year, mid last year, they were communicating that there wouldn't be any interest rate rises until probably well into 2023. But now we're looking at a reduction of money supply, potentially quantitative tightening starting this year, and potentially several interest rate increases. That is a big change compared to last year and had a big impact on the investment grade bond market. The investment grade bond market had the worst year since 2013. That was a year of the so-called taper tantrum when Ben Bernanke announced the so-called tapering, also a form of monetary tightening. This resulted also in a bad bond market. Depending on the duration, investment grade bonds suffered between 0 and 10%. Long duration bonds suffered the most, short duration bonds suffered less. And that was obviously a big disappointment for holders of investment grade bonds. A lot of private banking clients hold a lot of bonds, and they didn't have such a great 2021. At the same time, the rising prices also helped company earnings, which in turn helped the global stock markets because stock markets follow earnings. And on a global basis, global equities did really well. US equities more or less shot the light out. No matter whether you bought small caps, mid cap or large cap, the returns were really, really high. And the same is also true for India. Indian equities also did really well. The big loser on the other side was China, as well as North Asian risk assets like North Asian high yield bonds or Chinese high yield bonds. And that came with a lot of disappointment, very high losses, a real bear market. We haven't seen such a bad high yield market probably in decades. I think not since the global financial crisis. Luckily, most clients of this family office have globally diversified portfolios. So they typically had a very good year and only limited exposure to Chinese equities and Asian high yield bonds. Now let's talk about the development of our Fair Horizons purple to green and our safety building blocks. This is the part of the portfolio that has to provide stability, that is meant for shorter term investment time horizons. We typically look at investment grade bonds here, stable investments with limited volatility. Unfortunately, the rising interest rates produced losses for this category for pretty much all safety building blocks, ranging from 0% to 6.5%, which is obviously very disappointing, but yeah, can be explained given the circumstances. But we had some exceptions. We typically recommend a US inflation-linked bond index as well as a couple of actively managed bond portfolios from PIMCO, the PIMCO Income Portfolio managed by Dan Iverson, and the PineBridge Asia Investment Grade Portfolio, as well as the Principal Global Preferred Securities Portfolio. All of these did very well. They had positive performance, and that shows that it's sometimes worthwhile considering active managers, and we tend to do that. We combine index solutions with active solutions because we're the agents of the clients, and we're not distribution agents of fund products. As part of our Fair Horizons Purple to Green, we're also recommending so-called discretionary portfolio building blocks, P1, P2, and P3. And P2 and P3 also had a very good year, and that is because they hold about 20% to 40% global equities. And as those equities did very well, they could counterbalance the negative performance of the investment grade bonds. P1, discretionary portfolio building block P1, only holds short duration investment grade bonds and naturally had small losses, not big losses. The reason why I'd like to talk to you about these discretionary portfolio building blocks is because they're very well structured. They are based on factor indices from dimensional fund advisors, and they have an annual management fee of only 0.25%. They have a very long track record, and that gives us great confidence, and that's why we like to recommend it to clients of this family office, because they tend to do much better than the discretionary portfolio management offerings of private banks. I can honestly say that there's a very high chance that these portfolio building blocks are beating the bulk of discretionary portfolios in private banks. So please take a look. One last point maybe to safety building blocks is, yes, they had a tough 2021, and there's a good chance they will have a difficult 2022 because we're still in this interest rising environment. But we must not forget that this is the part of the portfolio that needs to provide stability and income. And we like this because there's little volatility in investment grade bonds, and a portfolio cannot only be comprised of risk assets. Risk assets we like for the long term, safety assets we like for the short term. That's why I would urge you not to sell your investment grade bonds just because the outlook is bad. Hold on to them. You need them as kind of portfolio insurance, but the part in the portfolio should only be as big as you need for your cash flow projections for the coming years. Now let's talk about the development of our Fair Horizons yellow to red, as well as our return building blocks. These are typically equity investments, and as we said earlier, global equities had a fantastic 2021. Globally diversified portfolios of equities had about 20% return, which is much higher than historic averages of about 6 to 8%. US and Indian equities were the biggest winners. They really had outstanding performance. This time, for a change, we also had very good results of European equities, because in previous years, European equities couldn't match the performance of US equities, but last year they could. The big loser, as mentioned, was China and North Asian risk assets, and that really had a very negative impact on some of our return building blocks, specifically the Bloomberg Barclays Asia High Yield Index ETF, the Fidelity Asia High Yield Bond Fund, the Morgan Stanley Asian Opportunities Fund, as well as the two very popular UBS China equity funds, UBS China Opportunities and UBS All China. All of these produced very disappointing paper losses that we haven't seen probably since the global financial crisis, and really disappointing. But there is some comfort. The long-term performance of US and Chinese equities has been quite similar in the last 2 decades. It's been around 8 to 10% on broad index levels, and that lets me believe that there will be a recovery. Maybe even 2022 will already be a year of a good recovery. But yeah, let's see what the year will bring. The same goes for Asian high yield bonds. The long-term return of Asian high yield bonds is similar to global high yield returns, and there's no reason to believe why there shouldn't be a recovery. That said, I would not overweight Chinese equities in the long run. I would probably keep it on a neutral level. That means I would only invest in China to the degree that it reflects the Chinese market capitalization. So we're looking at maybe about 10 to 20% in a global equity portfolio. The reason is that the policies of Xi Jinping are really a bit different from what we've seen in the past. And ultimately, these policies should have a negative impact on company earnings. That's why I think the market will probably attach a discount to Chinese equities. And there are enough other opportunities in the market, so I think it's not necessary to overweight China. US and Indian equities, they're naturally now looking a bit more expensive because they've gone up so much. At the same time, these companies tend to be very profitable. So here again, we would also not sell out of these markets. We would hold on to our allocation. Also for fresh money, we would keep buying stocks in these countries, but we would also probably play it as a market neutral position. That means 50 to 60% for US equities. Yes, US is a lot. It's a big chunk of the global equity market, and it hasn't paid in the past to underweight the US. And for India, the number is probably somewhere between 5 and 15%. I'd like to mention our discretionary portfolio strategies, although I've already done that to a certain degree, as well as the do-it-yourself portfolios, which we've highlighted in Reflections, to give you some idea on how you could compile your own portfolios. As I mentioned earlier, these discretionary portfolios from Dimensional Fund Advisors are really, really good. They're beating discretionary portfolio management in private bank by a wide margin, I may say. So please look at those, have a look at Reflections. And we've added a new portfolio under the do-it-yourself section. It's called the portfolio K, which stands for the German word Kinder. And here we want to express that these are portfolios with a very long time horizon. Basically money that we would stash away for our children. And I personally actually invest in this portfolio K. This portfolio is comprised of 6 actively managed equity building blocks. And in the past, this combination has beaten the MSCI World Index after fees by about 2%. That's why I basically put our children's money in there. And that's also a reason why I'd like to showcase it to you. That already brings me to the outlook to 2022. As in every year, I have to disappoint you here because I don't know the future. I know that a lot of market participants are now out there today and in these couple of weeks and tell us what the future holds. I must admit, I also attend many of these calls and webinars and so on out of curiosity. I don't mind good stories, but ultimately nobody knows the future. At the same time, what we do know, financial markets are comprised of debt markets and equity markets. And in any given year, one of the categories does better than the other. But rather than betting whether this should be an equity year or a bond year, it may be worthwhile just looking what combination of stocks and bonds, equity and debt would be suitable for your own situation. The concept of combining stocks and bonds based on investment time horizon and cash flow is not new. It's been done for a long time, and there's no reason why it shouldn't work in the future. So please take a look at your personal circumstances and try to understand where you are, when you need certain funds, which monies can be put away for a really long time, and then combine your portfolio. And Das Family Office is more than happy to help you here. I would say keep the allocation to investment grade bonds as small as you can, as small as your cash flows require it, because to this day investment grade bonds don't give you a real return. That means you're basically losing purchasing power by holding on to them. At the same time, you need them for portfolio stability, so keep that in mind. Money that you don't need for a long time should be going into high quality, globally diversified equity investments, because this is where you can expect the highest returns. And if you don't put money into these markets in the long run, you're missing out, you're leaving money on the table. Keep costs low. It's very, very important, because expected returns for stocks and bonds are somewhere between 0 and 10%. 0 for no risk term deposits and 10% for a long-term allocation in small company stocks. So if that's the context, if you have to pay about 2% to your financial product and service providers, you're already down quite a bit. So be careful that you don't overspend. Das Family Office is really trying to help its clients to keep costs low, buy the right investment building blocks at the right price, at a low price, at a good price. We can see that our clients benefit tremendously from this. We're basically the sole agents of our clients, and we have no affiliation with any financial product or service providers. We really want to avoid any form of conflicts of interest, because that's what private banks do, that's what financial service providers do, and we want to be different. Some of you may be tempted to take some profits. That's because you had a very good year 2021, but I would urge you to hold your horses. Don't do anything. Financial markets will continue to do well, even if there may be corrections on the road. There's a lot of evidence, a lot of research done on the fact that being in the market, being specifically in the equity market, is more rewarding than trying to time the ins and the out. Typically, people who leave the markets don't come back at the right time, tend to have to buy back their stocks at higher prices, have a lot of opportunity costs. So yeah, hold your horses, stay the course. I know that quite a number of people out there don't like stocks. They're really worried for whatever reason. They prefer to buy bonds. At the same time, I see these people not buying the super safe investment grade bonds, but rather high yield bonds and tier 1 capital or COCOs, preferred securities. And the reason for that is because these bonds carry high coupons, but they're still not equities. But in reality, this is a quasi-equity strategy. And as this strategy can be quite volatile, in fact, it can be sometimes more volatile than holding a little bit of diversified equity, I would like to encourage you to compare this strategy or compare what you're doing with a simple 60-40 equity investment grade bond portfolio. We can actually help you to do that, so reach out to us. Because this combination of 60-40 has typically outperformed high yield bond markets and COCO markets with lower volatility, lower drawdowns in really bad markets such as last year or the global financial crisis. I think I'd be happy if more of these high yield portfolios were switched into more ordinary traditional portfolio allocations. Then, yeah, that already takes me to the end. Successful investing is really a function of having a plan, keeping costs low, and staying the course. This is why we are here. This is why Das Family Office does exist. We want to make a difference. We want to help our clients and interested parties to have better portfolios, achieve better outcomes, and just be more successful financially. On another note, maybe that's then the last point, since Das Family Office has a fund management license, we're a CMS license holder by MAS, we also manage a lot of funds. We manage Cayman funds, we manage a UCITS fund, we manage Singapore private unit trusts, and we have launched a couple of so-called VCCs, Singapore Variable Capital Companies. This is a new structure that wealthy families and wealthy individuals can use for themselves. And we have developed a fair bit of expertise here. So if that is something that's been on your radar, please talk to us. I think you can benefit from our expertise here. That takes me to the end. I wish you a happy, healthy, and successful 2022. May all your dreams come true, and may it be a wonderful year for you and your family.